Well, we've done a few video series recently, touching on stocks, touching on real estate. Another important part of our portfolios that I wanted to spend a little time discussing is commodities, which we carry partly for inflation protection. And we usually divide those into kind of broad-based commodities like copper or energy, oil, natural gas versus the precious metals. Wanted to spend a little bit of time talking with you in terms of what we might be seeing developing there, where we might be seeing opportunities, as well as just the strategic reason why it makes sense to have some commodities as inflation protection for your portfolio going forward. Why don't you just pick one of those three to get us rolling with, Joe? What sounds good with here?
Well, let's talk general stuff first, okay? So the first message we want to send to people is we are not going to do what Eddie Murphy was doing in Trading Places. We're not going to be trading frozen concentrated orange juice for your portfolio. Where it's not what we do. You're not gonna find pork bellies on your statement when you get home. Listen, we trade these things like indexes. Okay, they are indexes. We buy commodity indexes. We buy gold in a form of an exchange traded fund. So it's not when we say commodities, don't get scared on us. We're not using leverage, which is really what kills people in commodities is the leverage. If you're trading futures, you're inherently using leverage, and it's you can wipe yourself out in a hurry. I have traded those things in my career and done well with them, but it's not something the average person needs to be doing. That's number one. Second thing is we do split we look at our commodity exposure as two things: precious metals, gold, and general commodities. As you said, that would be the Goldman Sachs Commodity Index, or maybe there's the Dow Jones Index as well. There's a couple different indexes you can use there. So in general, when the economy is poor, in general, you would have interest rates falling, and usually real interest rates falling, and that would be a time to own or to emphasize your gold holdings. It's kind of the anti-growth asset. On the other hand, when things are going better, when the economy is growing, then you want to emphasize more on the general commodity side. Now, there's also the factor of the dollar and so forth. All those things factor into this. Although the dollar really is driven in a lot of ways by the same thing that drives gold. It's driven by real interest rates and real interest rate differentials between countries. So the dollar is kind of a derivative in a way. The real thing you want to watch here is real interest rates. So when real interest rates are low or when they're falling and when they're low, you definitely want to own gold. And we saw that going into COVID, and we saw the 10-year tip yield went all the way to minus 1.2. Gold went up, made a new high around 2,100. But then as real interest rates started to rise, that it started to pull back. Started to pull back. You pull back from 2,100 into the 1,600s. It was a big correction. We own, first of all, it's a part of our strategic portfolio. There is an element here where there's some things that make these prices somewhat predictable. But you have to predict multiple things. You want to predict the price of gold, you also have to predict the direction of real interest rates. You get that wrong, you're going to get gold wrong too. Yep. So we do own gold and commodities as strategic investments, meaning they're always going to have some place in our portfolio. We will vary that based on what's going on with economic conditions and so forth, what the environment is, but we're always going to own some. So where are we right now? Well, real interest rates went all the way up to 1.75 on the 10-year tips, and it started to come down some just as nominal rates are coming down too. That's why, for instance, today you've got a big rally in the bond market. You also have a big rally in gold up $40. General commodities are a little more, like I said, a little more economically sensitive. They're not doing as well today. Here's where we're seeing some trends outside of just the indexes. And we find, and we do buy some individual commodities, again, not in the form of futures, usually in the form of an exchange traded fund. So one of the things we're seeing is platinum. Platinum and palladium tend to be kind of twin metals. They're both used in automobile production. Basically, the automobile companies and the parts manufacturers will use whichever one's cheaper. So palladium became very expensive. Now platinum's starting its run up. Platinum is starting to outperform gold, and it's just a trend thing. It is happening. It's one of those things that you can watch and you play it as long as the trend exists. We don't have anything in platinum right now. We're considering making a trade there. We think that that's not as strong, though, a trend as copper. Even though Short term, the trend up in platinum seems pretty strong because it's coming off a very low base. But longer term, we do believe that electrification is something that's going to continue. Detroit auto companies and really auto companies around the world have made some huge investments to make electric cars. In fact, I think the investment is so large and the government subsidy is so large that they cannot turn back at this point. So we're going to build electric cars, which means we're going to need electrical infrastructure, and it means we're going to need the raw materials to build those electric cars. And to me, the most obvious one and the one that is just, it's cheap right now is copper. You have to have copper to do all these things. You're going to build more transmission capacity. You got to have copper. You want to build generation capacity. You've got to have copper. You want to build a car. You got to have copper. You want to build a battery. You got to have copper. All of these things take copper. And we have not invested in copper production around the world over the last 10 years because copper prices have been fairly cheap. And so to me, companies that you can invest in there, that's one way to do it. You can invest in the mining companies, or you can go and just buy copper. You can buy copper in the form of an ETF, just like you can buy gold or platinum or palladium. That's a very interesting area to us, and it's one that has a fundamental story behind it, which we think is long-term. In a way, we think we probably prefer to play it with the miners because you get a little bit of leverage there, but we might also play it in the commodity portion of our portfolio too. What else are we seeing? It's really, I mean, I can't think of anything else off the top of my head that's really trending big. Agriculture had a big pop after Ukraine got invaded, but a lot of that's faded. But we do think agriculture, again, is a very interesting space because of geopolitics. We think countries, in fact, we know countries are going to stockpile food. They're going to stockpile a lot of commodities, actually. We've seen this in the European Union where it's an explicit policy. We will see it here in the United States too, I think. We're in a lucky position in the United States in that we do produce enough food for ourselves plus a whole bunch of other people. So I don't think we're going to be short, but we're going to stockpile stuff. And there's going to be times where, maybe it's better for us to buy from Brazil or Argentina than it is to do it here at home. But there are companies, again, that you can own in that space that we think a long-term trend is going to be positive. There's even an ETF, VEGI, which is kind of an interesting ticker. But you can own companies like FMC, or you can own companies like Bayer, which bought out Monsanto a number of years ago. Companies like Deere and Agco and stuff like that. The fertilizer companies like CF and Mosaic, companies like that on the fertilizer side. So there's a lot of different ways to play that. We do think, again, commodities in general, we think are going to be a good place to be, but there may be some specific areas like food and copper and so forth where you can make more specific bets. And how you play them it varies. You can do it in different ways.
Yeah, and let's kind of go into the mechanics of this a little bit more in terms of why we're positive. I think during the period we just came out of, we saw a couple issues really come to light. One is the risk of carrying really lean inventories, whether it's in materials or goods or whatnot.
Yep.
If those supplies get disrupted, all of a sudden your business isn't able to make product anymore. And so, that's kind of leaning more towards stockpiling. I think Ukraine was a big wake-up call, right, to a lot of people, that you could all of a sudden, for embargoes or war or whatnot, have supplies of whether it's food or fertilizer or natural gas get disrupted in a really meaningful way. I think we'd already seen the Chinese starting to stockpile even before this happened. Probably means that they had a little heads up from their friend over Putin that probably was going down. But those things aren't going to change or end. I mean, what we're seeing is we're going to see a world where people are carrying more inventory, they're stockpiling more, and that's going to drive more demand and going to drive prices for a lot of these, should drive prices for a lot of these broad-based commodities generally higher with a higher inflation rate, correct?
Well, and think about it too, from the viewpoint of each step of production. It's not just that companies that need copper, the automobile companies or whoever it happens to be that needs copper is going to keep a higher inventory of copper. It's also going to be the copper producers. If we're in an era where you have the potential for a COVID type disruption from a virus, well, they want to be able to sell copper regardless of whether they can put people in the mine or not. So at the mining level, even, I think you're going to see higher inventories there too. You're going to see higher inventories at every step of production, I think. And you're also going to see strategic stockpiling of raw materials, I think, on a national basis. We know the Europeans have a policy, an explicit policy of doing exactly that. Especially after their, what's happened to them with energy and so forth, they are definitely going to do that. Now, it's hard for them to stockpile natural gas, for instance. You got to have a place to put it, and they are kind of out of storage space at this point. But there's going to be other things involved there. It's not just going to be natural gas. It's going to be steel. It's going to be copper. It's going to be whatever they think is strategic, and it could be. In fact, it probably will be food. I think. In fact, I think food probably is at the top of the list. And that's why I say companies like Deere and AGCO and Mosaic and so forth, I think those are going to be important companies going forward. Strategic stockpiles on a national basis, and those could be quite large. Now you have to manage them, so hopefully we do that well. Which means which what that really means is I hope it's outsourced to some company that I don't necessarily want to leave it in the hands of the executive branch for sure, which is working very hard to empty the Strategic Petroleum Reserve right now. So maybe they're not the best folks to be in charge of that because there's going to be too much politics involved. I'll put forth a really strange proposal here. I believe that the Federal Reserve should have a balance sheet that includes things like oil and corn and natural gas and all kinds of things. I think it would give them an extraordinary amount of flexibility in managing their balance sheet. I think that I've said for many, many years, I don't understand the concept, the way we've developed it, of core prices. We have X food and energy as core. Why is it X food and energy that's core? Why isn't it food and energy that's core? That makes more sense to me. And in a sense, that's the prices the Fed ought to be most concerned about. But that's not a proposal that's ever going to get any traction. So just between me and you and whoever's watching.
Well, and I think if we also kind of go a little bit further in terms of kind of energy and politicalization and whatnot, we are seeing, especially in Western countries, really kind of restrictions on financing projects. We're not seeing universities produce graduates for these fields. We're seeing, I think we kind of feel that there's going to be a higher floor on oil and natural gas than there has been in the past, partly because of political policies that really seem to be aimed, whether you agree with it or not, at dampening production.
I think that is true, but I think that's also something that will blow with the political winds. There'll be times when people are in charge that want to finance those things, and times when they aren't. So that's going to come and go. Put it that way. I would say too, though, what you mentioned there about universities, and it's not just that the universities aren't turning out the graduates; it's that the kids don't want to major in those types of subjects.
Yep.
They don't want to work for Exxon, because they think Exxon's evil because that's what they've been taught since they were, a child. However, I'm a big believer in the market, and I'm telling you, you put enough money in front of them, they'll go work for anybody. So I think that problem will solve itself to some degree because, like I said, I think that's where the money will be. Incentives matter, as they always do. So we'll see how that works out. I do think, it's interesting. We're in a unique position here in the United States. And again, one of the reasons I'm positive about the U.S. and optimistic about the U.S., we do have a lot of natural resources here. Whether it's agriculture or natural gas. Listen, if we weren't sending natural gas if we weren't doing LNG to Europe, we'd have a glut. I mean, we got natural gas coming out our ears. So, we're going to be in good shape. We can help the rest of the world, hopefully, and make a buck off of it too. So, although I will say our European allies are not too happy with us right now. They're like, why are we paying so much for LNG when it's so cheap in the United States? It's like, well, by the way, Mr. Schultz, we do have to get it from here to there. I don't know why he doesn't get that. But anyway, I saw him, the German prime minister complaining about that the other day. And Macron, too, in France was complaining about the same thing. It's like, well, I'm sorry, but we're not going to settle at a loss. And besides, I got news for you. The U.S. government doesn't decide what natural gas prices are. That's a market thing. But anyway, point is we are very, very wealthy in natural resources. And, it's another theme, too. You mentioned Latin America. Listen, as part of kind of our geopolitical view of the world, we do think that there's going to be more of a regionalization of things. And listen, we think, I don't know if the Biden administration is going to do it, but whoever's in charge, we think needs to spend a lot of time doing some diplomacy in our own hemisphere here. We have everything we need in our hemisphere here. Chile for copper, Brazil for iron ore, Brazil and Argentina for foodstuffs, Colombia for oil and some other things. I mean, we have what we need here on our own hemisphere. We don't have to go to Asia for it. We don't have to go to Africa for it. But we need to have some diplomacy. We have free trade agreement with NAFTA, obviously with Mexico. We also have a free trade agreement with Chile and Colombia. We do not have one with Mercosur, which is the southern Brazil and the other countries down there. But I think that's something that's coming too. We need to concentrate on our own backyard for a while, which we've neglected for a very, very long time. And that's part of the reason why we have an immigration issue too at the border. We need to make it so that it's attractive for people to stay in those countries and prosper there, rather than thinking they have to come here to do it. Not that we don't necessarily need some immigration. We've talked about that too. We got a little bit of a labor shortage, but we do think it's important from a geopolitical standpoint for us to spend some time making it more attractive to stay in their home countries. So
Yeah, and I think an important point here is we aren't seeing a future of just economic collapse, and where it's going to be as simple as hoard gold and you don't need to buy anything else. But I mean, and certainly gold is something we usually hold at least a small amount of. It has a role, as you mentioned, when real rates really kind of come down. But it really seems that broad-based commodities are going to be very important with the world we're seeing going forward. A world where there is real growth, but there's less globalization and some higher prices going on.
well, listen, I would say that we certainly hope that general commodities are the better place to be, because if gold's the better place to be, that's seen something good is nothing good is happening.
Nope.
That is where growth is falling. Think about it. Listen, real rates falling. That's exactly what that means. Real rates falling means that real growth expectations are falling. Period. End of story. That's what it is. It could also be that inflation is rising. That doesn't, that may be correlated, but not necessarily. But it certainly doesn't say anything good about real growth if real interest rates start to fall, and especially if they go negative. So no, we definitely hope that it is a general commodity thing and we get to make our money there. We don't want to make it in gold.